Welcome back. You're watching our special coverage of the Reserve Bank of India's monetary policy, which has held rates steady at 6.5%. Our experts are with us to help us decode the policy. Again, Pranjal Bhandari, Chief Economist of HSBC, Anubhuti Sahai of Standard Chartered, Shanti Ekambaram, Whole-Time Director at Kotak Mahindra Bank, and Neeraj Gambhir will be joining us shortly from Axis Bank. Ladies, Shanti, let me start with you. What were your key takeaways? It looks like, with the threat of OMOs, the festive season round the corner, liquidity will be tight for a while. How does life change for you? What happens to rates from here on?
So first and foremost, a pause was expected and a pause it was. I think you have to delve into the details on 3-4 key things. Inflation trajectory, growth, credit demand. If you go by each, the macro indicators on growth are pretty strong. And you heard this is across industrial, agriculture, and consumption. Urban consumption continues to be very strong, and rural is just reviving. So there is credit growth happening. Second, inflation, which is the very important benchmark for the monetary policy, is estimated to be the same for this year and trending lower next year, on the basis of food inflation, and core inflation has come down significantly. And third, of course, like I said, the liquidity in the system was a deficit, but now with the ICRR winding down and the Reserve Bank of India has committed adequate liquidity. I think from a domestic perspective, all the factors are there for India to be the new growth engine, as the governor puts it. I would only worry about 3-4 things. A, global volatility, oil prices directly is inflationary for us. Any global food shock or shortage and any geopolitical tension, which could come through currency, including flows, if the rates in the US, let's say there's another hike or 2 or so. I think the risks right now are global. In the local scenario, I think 4% targeting was very clear. So we will watch for liquidity. And while the Reserve Bank of India said they will ensure liquidity will be adequate, government spending is going to come back, etc., etc., I will watch for how liquidity flows. As a bank, our job is make sure your deposits are in sync, your lending is in sync, and that's the core business model.
Well, of course, we'll come back to the deposits question. But Pranjal, let me come to you. Specifically on the inflation numbers, it hasn't really been tinkered on, the entire year basis, some small tinkering for the second and third quarter. But importantly, you earlier told us you're going to be watching out for the MPR, and there 4.5% is the average that we've got. What does this tell you about the future trajectory?
Yeah. Thank you. So, look, I think they gave us mixed signals on inflation. On the one hand, they sounded hawkish when they spoke about how we need to get to the 4% target, reiterated that. They also sounded hawkish when they came out with some revised estimates in the MPR. For example, they've mentioned somewhere that the upside risk to the current forecast could be 100 basis points if the full food production in Kharif and Rabi, crop grows awry. And they also said that the relationship between the rupee and inflation has become a little worse than before. Rupee depreciation can lead to far more inflation now than about a year or 2 ago. So they did bring all of this on the table. But on the other hand, they also had an extremely low, 1 year ahead inflation forecast. I thought it was surprisingly low. For March 2025, they have it at 4.3%. Last time when they had unveiled it, it was 4.4%. So they actually cut it. This is a bit surprising to me. And honestly, I'm going to take it with huge, error bands, because there's so much that's not known. We don't know where oil is going to be. We don't know where monsoons are going to be. We don't know where the state of the economy, global economy is going to be. So I think I'm going to take it with a pinch of salt. I think it will be foolhardy at this point to extrapolate this and sort of associate it with some real rate number and say, oh, RBI is going to start cutting rates in the middle of 2024. I think that will be a little foolhardy and a bit rushed, because the truth is that if India is going to grow as well as what the whole world is expecting, in the short run, that has to be inflationary. And in India, core inflation rises very quickly when growth rises. So they have given us a very low 1 year ahead inflation number, but I'm going to take it a little bit with a pinch of salt.
Anubhuti, what about you? Do you also agree with what Pranjal is saying? The concerns that RBI has highlighted very much on food inflation. The MPR also highlights significant upside risks to this number. Is it a tad too optimistic to expect it at 5.2% by the end of the year, 4.5% for next year?
Sure, thanks for that question. I think, first of all, when we are looking at the December end and the March end forecast, which RBI or the MPC has provided, probably at this point in time, given the available information, I do agree with the MPC's projections that there was very little need to tinkle around with those numbers just at this point in time. Right now, the upside risk to those numbers would primarily emanate from food prices in case there are any future weather disruptions. So I think we have to be a little bit more patient to understand how the harvesting plays out on Kharif and how the Rabi sowing plays out. So I think for the near term, that is for December and March 24 numbers, it was pretty justified to keep those numbers unchanged. For FY25, I think when we are talking about the MPR numbers, these are model-based projections. When we come closer to the monetary policy decisions, which would be the case in, say, June or September of 24, these numbers change dramatically. Even if you look at the baseline forecast, I think for H2 FY24, RBI still has a very like a conservative estimate on oil, which is at 85, and those numbers can change a lot when we move into next year. So our sense is near term, completely agree with those numbers and the forecast which MPC has provided. FY25, completely agree with Pranjal there that these are model-based projections, extrapolations, assuming business remains as usual, which never does. So we'll have to watch out when we are closer or we are into FY25 to assess the inflation risks then.
Okay, thanks a lot for that, Anubhuti. Neeraj, look at the way the yields have gone up. Now, what is your range? I mean, 10-year.
Slightly hard to tell you the range at this point in time because the market is still digesting this new piece of information about the use of OMO for managing liquidity. I think we'll have to wait and see what kind of OMO auctions are announced, what's the size, what securities are being used, etc. I think for now, the market will look at what happens in today's auction. We have auction today, and after today's news, we'll have to see whether this auction goes through smoothly or whether there's a devolvement. That could add to a bit of a pain of the market, but my guess is that we'll probably settle somewhere close to 735 to 740 levels in the near term, in a very near term. And from there onwards, it will depend upon how the liquidity situation plays out, what Reserve Bank does on the OMO front, and what happens to the global yields, particularly the yields in US. I think we were kind of protected from the US, sort of sell-off that happened. Part of the reason was that there was this anticipation of bond flows that will happen as a result of portfolio inclusion. Now, this change in the policy stance of managing liquidity through OMO has kind of appended a bit of that estimation. So market will take a bit of a time to settle down, my sense is, Lata.
Okay, but Shanti, in the meanwhile, I mean, this clearly is not going back to, what do you call status quo ante. It's not going to 7.14, I would assume. So do you think banks are going to be faced with higher deposit costs and they will be passing it on in the form of higher lending rates?
So Lata, two things are important. Credit growth, which continues to be strong if you look at the data that is coming out. Different banks have different data. And so far, the way banks have gone about their deposit accretion, you haven't seen any change in rates. If you look at the mainline banks, for the last 5 to 6 months, they have been very steady. So I think we will be watching demand, and the festive season is upon us, so expect demand to be strong. But each bank has to carve out a strategy. I mean, for Kotak, I can talk. We have a three-pronged strategy: CASA, active money, as well as term deposits, which is right now feeding our growth. So should there be a contraction in liquidity and should there be a demand sudden surge, then you could see rates go up, which I guess will also translate into lending rates other than those linked to repo perhaps. So we're going to watch the situation. I think right now banks, if you look at all what you're seeing and hearing, have their strategies in place for the deposits. But I expect volatility and thus RBI to manage the liquidity. So there could be some spikes. So we'll have to wait and see.
Neeraj, CPs also would have gone up, no? I mean, I don't know. I can't see the CP yields. I only have the CCIL website with me. But it would be across the board. So corporates are going to pay more. Borrowers are going to pay more, right?
The impact of today's action is much more on the longer end bonds, Lata, rather than in the shorter end of the curve. Shorter end of the curve typically reacts much more to things like CRR changes, etc. That hasn't happened. Thankfully, ICRR is being sunset. So at this point in time, the reaction is much more on the dated government bonds and the longer end of the curve and the OIS and a little bit of the corporate bonds side as well. But it will take a few days for things to settle down before market fully understands the import of this change in the stance on liquidity management.
Okay, okay. Pranjal, would you look at this? See, the cost of money globally has already gone up. And the cost of money, at least as far as market rates are concerned, has gone up over the last 2 hours. I agree. It's a very short period. But you don't see any long shadows on growth? 6.5 it is for you also?
Well, my numbers are a little lower. They are closer to 6%. But, you know, there are big error bands and a very volatile time. I would say growth in India is extremely strong. We spoke about this yesterday too. Rural India might be a little weak, but urban is extremely strong. You look at labor market data, the number of people employed today is far more than in the pre-pandemic period. Both the formal and the informal sector are doing well in the urban, in urban India. A lot more people are getting access to credit that they were not getting in the past. So even if, you know, cost is a little higher, a couple of basis points higher, I don't think at this point this is going to really blunt the story, the strong growth story that, you know, we've seen. And honestly, this is not just in India; it's also in the US, right? People are expecting month after month that now growth is going to slow, but it is not happening. I think some countries have some differentiated structural elements which are keeping growth quite buoyant.
Okay. Neeraj, what's your sense about NBFCs, because they depend on market to borrow? So while the cost may not go up for banks immediately, you think it will go up for NBFCs, right?
Yeah, so I think corporate bonds yields will likely move in lockstep with the government bond yields. If we see about 15 basis point move has happened in the bond yields in the government side, so a similar yield could play out in the corporate bond side as well. What we typically see is when the yields go up like this, the issuance activity comes down a little bit. I think the issuers tend to wait and watch and let things settle down before they come back into the market. So till such time that happens, a very clear fix on where the corporate bond yields are settling may not be easy to get. But I do expect a commensurate increase in the corporate bond yields as well.
Okay, fair point. Just a final couple of questions to the economists. Anubhuti, your growth and inflation target for next year?
So for inflation, we are higher than what the model-based projections are there in the monetary policy review. So we are at 5%. Our sense is going to the handle of 4% on a sustainable basis will be difficult given the global commodity prices, our view that oil is likely to remain above $90. And of course, we live in times of climate change. On growth, we are looking at a 6% growth number even in fiscal year 25. We have to take note of the statistical buoyancy which even the next June will have, and that on its own will pull up the average growth number a lot. But overall, based on the strong India fundamentals, our view that real wages both in rural and urban areas are likely to improve. They are already improving and are likely to remain a trend even in FY25. Our sense is that growth is likely to hover around 6% both this year as well as next year.
Okay, give me a monosyllabic answer. First rate cut, when?
June 24.
Pranjal, your estimate of the cut?
Very shallow rate cut of about 25 basis points around the same time, June 24. But one more thing here, if they want to ease, they can also ease via the liquidity, right? Right now, call money rate is at 6.75. At some point, it can come down to 6.52.
Yeah. Okay, Neeraj, yours?
I think it's too early to call for a rate cut. Going by the inflation forecast, I think we're still going to be in a very status quo kind of a policy for some time.
And Shanti?
I think it will be paused for some more time. I don't think, I can estimate that it'll be June. But RBI will manage it through liquidity measures rather than a rate cut. Because even if you look at the projections for next year for first quarter and second quarter, the inflation trajectory is still in its 5. It's only towards the last quarter that they've really dropped their inflation projection. So I think if the global interest rates, Lata, continues to be strong and pause for long, I don't see RBI dropping the rates. They will manage inflation through other tools they have. Unless, let's say oil goes to 120, there's a massive increase, then I expect the reverse.
Okay. Oh, of course, then all bets are off, of course. Neeraj, Shanti, Pranjal and Anubhuti, thank you very much indeed for joining us. Thank you, Ritu Singh, as well, for parsing the monetary policy. I think the key takeaways are quite positive for stock markets. I mean, pre-policy, post-policy, it's a 25 basis increase that you're seeing in the indexes. So clearly, the fact that interest rates have not been hiked, the boat hasn't been rocked, has been taken well, and growth numbers are strong for next year as well. 6.5 is the central bank's forecast, and everyone agrees growth is strong. For the bond markets, bad, disastrous day. About 20 basis point rise in yields. So bond dealers who are long are sitting on losses, and I think it's negative even for NBFCs because they borrow from the bond market. So immediately it's negative, but of course yields will find their own levels in course of time. Otherwise it's status quo. But yes, cost of money has clearly gone up. However well or however differently you want to put it, RBI has tightened and increased the cost of capital. No taking away from that. That's it on the special coverage of the Reserve Bank's monetary policy, coming to you from Mint Street. After a break, other news and details will follow.